we're mainly, I mean, if you think about the U.S., we're mainly a U.S. for U.S. company, right? So we have about 120,000 employees. We make, move, and sell in the U.S. We have about 60 factories, and we have 500 depots. So we are a very heavy infrastructure, a high labor intensive company in the U.S. So most of the value is created in the U.S. However, there's ingredients that we bring from outside markets, things that either cannot be produced in the U.S. or otherwise. So we're vigilant on what happens with tariffs. We've been working on both cost reduction. We've been working on changing some of the sourcing and optimizing our revenue management to mitigate for the impact of tariffs. It is a factor. It's not a massive factor, but it is a factor. But we're a very U.S. company, but there's some flows of materials that come from outside. And we need to be prepared to mitigate those efforts and not penalize the consumer with these decisions.
Yeah, because that's what I was going to ask. Are consumers going to have to pay higher prices ultimately because of some of the ingredients that you have to get from overseas?
I think there's probably, Sarah, a big portion that organizations and businesses can absorb through productivity and other choices. But obviously, if tariffs become to a higher level, there is going to be a limit on what businesses can really absorb through productivity or resourcing, and we will have to pass on some of this to consumers. But obviously, we'll do it in a very conscious way and making sure that consumers stay within our brands. But I assume that is the same for other companies that are even more exposed than we are to tariffs.